So picture this. Two people walk into the exact same bank branch on the exact same day, but they are experiencing two completely different realities. The first person, they overdraft their checking account by like $4 buying groceries, and the bank's automated system just slaps them with a $35 fee for the privilege. Boom. But the second person, who happens to hold a much larger balance, well, they have a private banker who already knows their name, proactively flagged an upcoming large transfer, and automatically waived a fee before it was ever even mentioned. Same building, same logo, same day, but an entirely different set of rules. I'm Zach, and welcome to the Zak Wealth Files Explainer. Today, we're breaking down a system that quietly governs your money.
Now, these different experiences, they aren't accidents. And it's not the result of, one rogue branch manager having a good or bad day. What you're seeing is the result of a formal, published, highly documented tier system that essentially every major banking institution runs. These tiers are based entirely on combined balance thresholds. Your bank has already sorted you into one of these invisible buckets. They just probably didn't explicitly tell you which one you're in, or more importantly, what leverage it actually gives you.
Before we walk up this ladder, we really have to understand the objective arithmetic behind it. It's not personal, guys, it's just profit math. And understanding this math is literally the first step to building real wealth. The business model of a bank is actually incredibly simple. A bank sells three things: the use of your deposits, lending products, and services. So a customer with a large, stable balance and multiple products, think a mortgage, some investment accounts, maybe a few credit cards, they are worth orders of magnitude more to the institution than someone with just a small checking balance. Wealthier clients provide way higher revenue, and statistically, they represent a dramatically lower risk of default. So in the eyes of the bank, this wealthy client isn't just a better customer, they are an entirely different product category altogether. Because those wealthy clients are just so incredibly lucrative, it literally changes the physical structure of the bank. Think about it. Relationship management, having a dedicated private client team, custom lending structures, proactive phone calls. That stuff is incredibly expensive. It simply doesn't scale to millions and millions of accounts. Federal Reserve distributional data clearly shows us that wealth in America is extraordinarily concentrated at the top. And because of that extreme concentration, banks rationally build these elaborate, expensive structures to court the top tier while pretty much automating the entire customer service experience for everybody else.
That automation we just talked about, that is the starting rung where the overwhelming majority of banking customers live, typically operating with combined balances far below $100,000. The operating model here at this tier is incredibly simple. It's standardized products, call centers with very limited discretion, and fees. Just look at this number, $12.4 billion. That's billion, with a B. That is the staggering estimated amount paid by American households in overdraft and non-sufficient funds fees in 2025. This fee machine runs hardest on the mass market tier. It generates billions where balances are small, and the customer's relationship leverage is at its absolute lowest.
And honestly, this brilliantly illustrates the second, quieter drain happening down at Tier 1. The FDIC's national average savings rate sits around 0.38%, but at the largest national banks, a standard savings account might pay you as shockingly little as 0.01%. Contrast that against competitive high-yield accounts paying somewhere in the 4% range or more. If you simply leave your money in a standard Tier 1 big bank account, your loyalty is actually a penalty. It's not a perk. You are actively losing money to inflation every single day.
So what happens when you actually start growing your assets and move up the ladder to the levels where banks start naming their programs and unlocking real, tangible benefits? Well, the next rung is what the banking industry calls the mass affluent. This typically refers to households with roughly $100,000 to $1 million in combined assets. I really want to explicitly define this industry jargon for you because this is exactly where the tier system stops being standardized robotic call center automation and starts becoming highly personalized.
Now, here's the crucial point. These thresholds are frequently way lower than most people realize. For example, Bank of America revamped its rewards program, and their Preferred Plus tier begins at just $30,000 in combined balances. Chase Private Client sits around $250,000, Citi Priority is below their $200,000 Citi Gold tier, and Wells Fargo Premier is at $250,000. Here's the secret they don't exactly broadcast. Banks count your combined checking, savings, and investment balances held at their institution. A checking account, a savings account, and an IRA held all in one place can actually add up to that $30,000 rung pretty quickly. This is absolutely not out of reach for a massive share of everyday households over time.
If you keep climbing, you hit high net worth, which is classically defined as individuals with $1 million or more in investable assets. This is the realm where dedicated relationship managers step in, where lending terms are actively negotiated rather than just pulled off some retail rate card, and exclusive investment products start to unlock. But hear me clearly on this one. While a private banker adds genuine value, they are still, structurally, a salesperson inside a bank's product ecosystem. They are not necessarily a fiduciary. You always remain the ultimate decision maker for your own wealth.
Now for the most important part of this entire explainer. You do not have to wait until you have $1 million to be treated like you matter. Standard tier customers can claim upper tier perks simply by learning how to ask. LendingTree does these recurring surveys on people who ask financial companies for concessions, and the data is just absurdly consistent. Success rates for fee waivers sit in the 80 to 90% range when customers just explicitly call and ask for them. The people who ask get what they want the large majority of the time. The people who quietly accept the default posted price, they get it 0% of the time.
So here are the perks you can claim right now. Number 1, fee waivers. It is infinitely cheaper for a bank to waive a $35 monthly maintenance or overdraft fee than to spend hundreds of marketing dollars trying to replace you. Number 2, the real savings rate. Move your cash to a high-yield account, period. Number 3, a named human contact. Ask for a specific point of contact rather than getting routed to the general call center every time. And number 4, threshold knowledge. Ask your bank directly how close you are to the next tier. The default state of the mass market is the posted price, but remember, banks hold significant discretion underneath those defaults.
To make this super simple and totally actionable, here is your concrete Zak Wealth Files framework. These are the exact marching orders you can implement this week to optimize your banking relationship. Step 1. Locate your rung. Check your bank's website tonight and find out exactly what their balance thresholds are. Step 2. Consolidate deliberately. If you've got accounts scattered everywhere, run the math. See if combining them crosses a tier threshold at a single institution. Step 3. Ask for waivers. Pick up the phone this week, cite your history as a customer, and just ask them to waive a specific fee. Step 4. Grant yourself the rate perk. Moving your cash from a 0.01% account to a 4% high-yield account, that's a decision you make today. It's not a tier you wait to reach. And Step 5. Ask what unlocks next. Know exactly what the next tier provides so you can actually plan your wealth strategy around it.
Now, just a quick honest caveat before we wrap up to make sure you have the full picture here. The data and thresholds discussed in this explainer reflect publicly reported industry structures, like that Bank of America rewards revamp we talked about. But thresholds do change, and perks are always conditional upon maintaining those balances. Some banks even charge fees if your balance drops below the tier requirement. So this explainer serves purely as general education. It's not personalized financial advice. Always verify terms with your specific institution, and remember that individual situations should always be discussed with a licensed advisor.
The invisible ladder inside your bank is very real. But the good news is, the bottom rungs are much closer than you think, and the power to negotiate sits squarely in your hands. So I have to ask, have you ever asked your bank directly for a fee waiver or a better rate? Let this be the week you finally make that call. But once you start keeping more of your own money, the very next question is, where do you put it to make it grow? If this framework brought you some clarity today, make sure to subscribe to Zak Wealth Files as we tackle that exact question next. Remember, excitement should always come from clarity, and the people who ask are the ones who win. See you next time.